Good afternoon and welcome to today's webinar. My name's Simon Smith and I'm Head of Research here at FX Pro. Today's webinar is one I try to do once every 2 weeks, unless I think last week I ended up having to move it for circumstances beyond my control, so I apologise for that. My colleague lengthened a title, so it's now called How Current FX Fundamentals Affect Price Trends. Basically, that means I'm just going to look what I think is driving FX markets at a point in time more from a fundamental rather than a technical perspective. For that, let's look at the disclaimer, which essentially says this is a marketing communication and should not be considered investment advice. And as always, the risk warning essentially says that leveraged FX incurs a higher level of risk, and you should seek independent investment advice if necessary. The webinar software, if you haven't been on before, there should be a little drop-down thing at the top. So if you go to the top of your screen, there's a drop-down menu. From there, you can access a Q&A panel. So during the webinar, if you could keep questions related to the topics I'm talking about, that would be great. And at the end, we can widen it out to other questions should you have them. I will answer questions verbally and anonymously, and also do tend to record these webinars and put them up on our YouTube page, but just to be aware that I don't refer to anyone by name, so questions will remain anonymous and only seen by myself. So what are we, 20 days into the year? So we've just been covering where we've been this year. I think it's maybe sort of grappling with a theme because tapering was obsessing us for the last pretty much, well, more than 6 months of 2013, so where we are now. Dollar dynamics have been interesting, perhaps didn't get off to a decisive footing, but certainly the stronger dollar theme is coming through, so the reasons around that and what's driving that. The euro as well, interesting dynamics going on there. I still think there's underlying support, and I'll go on the reasons for that. The Aussie also has been interesting. Started off on a decent footing, and certainly after the first sort of week or 10 days, we were certainly seeing the Aussie and the yen performing the strongest, which was interesting because those are the currencies which, for different reasons and different extents, investors are seeing weakening this year. So we'll have a quick look at the yen and then looking at gold as well, because I know quite a lot of you do look at gold, and it's always interesting, and I think the dynamics are always as interesting. We're now in our 5th week of gold increases, so that is worth taking a look at. Bit of a blurry chart, but just what we've seen so far this year. So you can see the yen has been the standout in terms of the gainers. The dollar has been asserting itself, not against everything. The Swedish krona and the Kiwi on the majors are the standouts. Also interesting on the other side of the equation, the Canadian dollar, we've seen obviously Canada escaped pretty much the ravages of the global financial crisis, didn't have over leveraging the banking sector, so Canadian dollar performed relatively well. Were talks even sort of last year of possible rate increases from I think the current 1%, but now sort of softening domestic economy, weaker oil prices, more competition on the domestic resources, certainly from America, so they're actually exporting less commodities to the US as the sort of shale gas revolution comes more online. So the Canadian dollar has been suffering quite a bit more recently. The euro and the Swissy have obviously softened, but I think there are sort of factors there worth noting, especially on the euro. And the Aussie only modestly weaker, but to say that's come at a time when we've seen initial gains, but that's now fading. The dollar index, so I've looked at the dollar index, the daily charts is a bit small on the Bloomberg charts, but that's showing from September to now, daily chart, dollar index. You can naturally see the Fed tapering happening in the middle of December. We didn't establish a dollar uptrend then. The Fed was very marked in its language in terms of softening the forward guidance, removing expectations as had been happening even back here, expectations of interest rates themselves going up. So tapering didn't sort of cause the upset in financial markets a lot were expecting, but nevertheless I think what is now happening here is that we've seen certainly good data flow supporting that stronger dollar. So it wasn't tapering itself that I think was adding to the firmer dollar tone, but certainly the data we've seen since then has added to that. You see that on this chart here. So again, I look at this quite a bit. It does tell me what's going on with some of the dynamics. You can see on the white line the data surprises. So with data coming stronger than expectations, that's a sort of weighted average of survey data, inflation data, actual activity data. So that has generally been coming in stronger than analysts on the street, as we often say, have been expecting. So you can see that initially wasn't really adding to the dollar, but you see the dollar is now on the dollar index, strengthening on the back of this data. For example, GDP data out at the end of January is seen with a 3% handle after the about 3.3% annualized expected now. I think sort of in the middle of Q4, so November, people were probably even looking at 2%, 2.5%. Why? Because we'd seen a strong inventory rise in the Q3, and that was seen unwinding and actually taking away from being a drag on GDP growth. So we've seen other data stronger, so that's why we've seen this correction higher here. So actually we're now looking at sort of a decent 3% plus handle on GDP when it's released at the end of the month. So this is added to this stronger dollar dynamic there. So orange is the dollar index, which you can see, as I said, previous chart, similar thing, but just done on a daily close on this chart. So you can see the way we're actually now catching up with the better data we've seen. As I say, just make that point again, that now I think 3.3% for so Q3, I should be getting behind myself. That should say Q4. So Q4, the first reading, seen a plus 3%. So that in itself is adding to the tone. And you can see the correlation. I think this is a 3-month correlation, rolling correlation between dollar data surprises and what we're seeing. Let's look at the euro. I think it's very interesting. Look at euro money market rates. Last week on 3-month money, we touched 0.3%. Of course, that's still pretty low, but nevertheless, it's the highest we're seeing on 3-month money since just after the middle of 2012. So we're already at an 18-month high. That's despite the fact we saw the ECB cut rates in May from 0.75 to 0.5, and again towards the end of last year in November from 0.5 to 0.25. And you can see that rise that was happening in the end of last year here. So even though the ECB has cut rates twice, what's actually happening to money market rates, the rates paid between banks, has been rising into the end of last year, and even since then we saw the quick move lower as the year end passed. A lot of banks sort of want to hold on to liquidity over year end, and that was even more the case this year because the bank or the ECB was conducting stress tests. So you can see that we saw a put forward move higher. A lot of that to do with the excess liquidity. So I won't go in detail on this, but the reason we're seeing this is banks are repaying loans back to the ECB. So excess liquidity essentially means the liquidity banks are holding above and beyond that they're required to hold by the ECB. So I think all banks have to hold a certain amount of their liquidity with the ECB. It used to be 2% of eligible collateral in operational reserves. So they've tended to hold more than that because there's a lot of abundant liquidity. They've been taking out loans as well, 3-year loans, and they were taking out loans over year end, which have been subsequently repaid, which why you see the drop there. So this excess liquidity has been falling, and that's why you've been seeing money market rates rise, even though actual ECB rates have been cut. So this chart is quite important for understanding that dynamic. It's certainly one of the aspects that led me to think that the euro would be pretty strong into year end, and it's still a support to the euros. To make that point there, just again, so it is this excess liquidity that has been keeping money market rates firm and actually adding to the underlying support for the euro, which into year end meant a stronger euro, and I think this year has actually kept the euro relatively well supported. So even if we see the euro do hold up well, so it's likely to be a stronger dollar environment. Sorry, I did this rather quickly this morning, so I do apologise. So basically making the point that the euro should continue to perform comparatively well in a stronger dollar environment. Let's look at the Aussie. As I said before, we had a decentish start to the year, so we were above the 90 level Aussie dollar. So we did touch the 50-day moving average in the middle part of early part of last week. So we've slumped since then. Why? Employment data is disappointing. We saw a fall in headline in employment, even though the unemployment rate actually held steady. Greater concerns on the domestic economy, so that is feeding through to the Aussie, but also I think we did go against the grain of underlying expectations in the early part of the year. So the Aussie was finding some strength, but I think above 90, it seems that investors are pretty nervous about sort of trying to push for further gains on the Aussie itself. So a lot of reasons why we might see it lower. We're certainly seeing at least one more rate cut from the RBA. So rates there are currently 2.5%, were as high as 4.75% in a couple of years ago. So it's either to go short currency. When rates are near sort of 4.5%, 5%, the Aussie was very much a carry currency of people borrowing when there was excess liquidity in dollars and yen, etc., putting it in the Aussie because they're gaining on that carry aspect, so gaining from the interest rate differential. That is obviously less now, so it's reducing carry trades, but it also means that it's easier to short the currency, so the higher the cost of carry is negative cost of carry when you go short the Aussie is a lot less, so less of a sort of hurdle, let's say, to going short that currency. It's also less interlinked with China as the investment boom slows and the economy slows. So you saw today with GDP data, pretty much in line in China with 7.7%, but we're still talking about 7% handles, not the double digits we were seeing a few years ago. But also China itself is shifting its economy away from sort of overinvestment more to domestic economy. So that's a dynamic that's certainly been evident on the Aussie for well over a year ago. I think even sort of a year and a half ago, it's first noticing this change in dynamics. It's basically trading less like a sort of China story, less like a commodity story, more like a domestic fundamental story, which is why the data such as employment data is having more of an impact, and it's being less of a carry currency and less interlinked with the global cycle because the rate differential has moved and the excess liquidity we were seeing in the US has also reduced, so there's sort of less money chasing these returns. So all these are still keeping in mind the year-end target, which I have at sort of 0.81 on Aussie dollar, I think still remains perfectly valid. Just touching on the yen, once again, I think it's thwarting those. It's very interesting, I think the middle part of last year, after the first burst of yen weakness, a lot of frustrated bears right up probably to the early part of November 2013. We had the sort of easy wins on yen weakness, but we didn't really see further yen weakness coming through even after the upper house elections in July on the part of the government. So that momentum wasn't there. A lot of frustrated yen bears. I think they're being frustrated once again by the price action we've seen so far this year. Focus now is on the consumption tax hike, which comes in April. So consumption taxes are rising from 5 to 8%. Very controversial move, this, because obviously it does add to inflation, but only temporarily. So that will feed through into inflation over the coming year, but then the sort of change will fall out. It's what's called a base effect. In April 2015. So yes, it'll get them nearer to that 2% target, but you have to look at sort of the underlying rates excluding that hike to really get a sense of underlying inflation. The reason why it's controversial is because back in '97 they hiked consumption taxes again at that time. I think it was a bit less than that, but nevertheless it was arguably, people debate this, one of the factors seen that pushing the economy back into recession, because naturally consumers, knowing such a tax increase will come up, will tend to sort of front load consumption, so buy big ticket items as they're called, cars, washing machines, etc., or anything that falls within that consumption tax ahead of that April increase. So that obviously naturally leads to a weakening of growth in the months afterwards. So the question is whether the economy has got enough momentum to sustain positive growth even in the face of such a change in consumption tax. So I think this is starting to get a bigger factor on the yen. I think it's very notable the way that literally at the start of the year you've seen this trend in the yen reverse on dollar yen. It's obviously been as partly a dollar dynamic, but naturally the fact that the yen is firmer versus the dollar shows that it's also a yen dynamic going on there. Well, we'd seen I think 9 weeks of continuous uptrends on the weekly chart. So you could say technically it's probably looking a little overbought on a sort of momentum perspective, at least on dollar yen. So naturally, I think we've had some pullback. But I think within that, there's also concerns that that this consumption tax will potentially have an impact on the economy as we go forward. Just want to finish off looking at gold. This is the weekly chart. So you can see on here we have seen 1, 2, 3, 4 weeks of consecutive gains. I think we've not seen that since September of last year. So it's certainly a strong start to the year for gold. We've naturally come off. We had new lows there, but we'll very quickly come off those. But the highs were still seen more than 2 years ago, and certainly during this time we've seen a lot of, as I said before, investment demand for gold shaken out. A lot of another chart which I've shown before shows the ETF, gold held in ETFs, was still rising right up to the end of 2012. So a lot of that has shaken out of the market, and I think a lot of the factors I mentioned back in October probably still relevant. I wrote a blog back then looking at the outlook for gold. A lot of the points there are probably still valid. I think at that time I was seeing gold making a sort of base around sort of current levels and gradually rising, but I think there's still scope for some weakness in the first half of the year, which could see spot gold down to 1,000, especially if we do see the sort of firmer dollar environment coming through as the Fed gradually tapers through the course of the first half of 2014. So in terms of the gold, as you can see from the charts, I think go back and read that blog if you have time and want to look a bit more in depth. And I've sort of blogged on gold sort of once every 2 or 3 months really, and been relatively bearish over that most of the time as well. But I think it's being a bit more constructive now, but still acknowledging that the firmer dollar could pressure gold certainly in the first half of the year. But nevertheless, I think the fact that we've seen sort of 4 weeks of gains, and in fact I saw something this morning about Goldman Sachs being bearish on gold, tends to have people going in the opposite direction as well, and certainly talk of decent demand out of Asia has all gone to support the price. So that's it for the moment. We've been talking for about just under 20 minutes, so I have time to take some questions at the end. As I said before, you can find the Q&A panel at the top of your screen, little drop down. If you post it in there, you should be able to ask questions. And as I said, they're only seen by myself. I do answer them anonymously and verbally, so you are not sort of, it remains anonymous throughout and also on the recording. So one question coming through just on the Fed, obviously it's quiet day today, but we've got the Fed meeting at the end of the month. Will the Fed continue to taper? Of course, I think in all probability they will. We did have that weaker employment report at the beginning of the year, so the headline jobs numbers were weaker than expected, and that did cause some to question whether the Fed had done the wrong thing. I think it's always difficult at the end of the year, December and January. There's actually working through the seasonal numbers is difficult for most countries. So I think the Fed will continue to taper. Naturally, they did the smallest amount, 10 billion in December. I think they'll probably do a similar amount, no more, at the January meeting. As I said, even though the employment side was weaker, the underlying trend is still close to 200,000 on headline payrolls. And also, as I said, the growth numbers, the momentum numbers have been stronger, which is why we're now looking at nearly 3.5% annualized growth in Q4. So I think that in itself is underlining the fact that we should be able to see the Fed still taper, but in a way that doesn't disrupt markets. Someone's asking about the CAD. Let me just get a chart. So Canadian dollars, you can see significant weakening again at the time of the jobs report there. We were seeing, so we're now seeing, if we go to the weekly chart, stretch that out, we're now at levels last seen really in the sort of late part of 2009. So you can, so why is that happening again? As I mentioned before, the Canada has been relatively unscathed by the financial crisis. Their banking sector was in no way hit in the same way as the US one was through subprime. Much better sort of balance sheet and leverage liquidity positions allowed Canada to really ride out the crisis better than most, and for that reason, the Canadian dollar did also hold well. So overall, I think even last year they were talking about the potential for actually putting up rates, and the central bank has been relatively optimistic on that front. There's now even talk of the possible rate cut, which I don't see coming through yet. Will they do further stimulus measures? I certainly, I'd imagine more coming from the government side rather than the rate side at the moment. I think the message from a rate cut would be potentially not taken that well by markets. But nevertheless, rates are, still relatively higher in the US versus the US. I think the 1% repo rate at the moment. So I think that's still light to hold for the moment. But nevertheless, there's a chance that we do start see some expectations, because naturally at 1%, it's still versus the US is 0.25. There's still a decent amount of carry in the CAD, so weakening that through rate cuts would potentially push the CAD lower. But I think for the moment, I would see the sort of CAD holding around these levels, maybe pushing it back above the sort of 110 level as the dollar strengthens on the tapering story. But I think it's one of the interesting ones to watch, because it's where you get this divergence is always interesting of policy, when central bank potentially tightening or reducing the looser policy as you get in the US, and another one going the opposite direction. Where else we're seeing that, obviously, naturally on Aussie Kiwi, where again that sort of policy divergence has been one of the powering factors behind what we were seeing on Aussie Kiwi last year. So when the RBA was cutting rates, and the potential for higher rates than the RBNZ was coming through as well, so you can see that it's a pretty powerful dynamic, and one where we've struggled to get such divergence in the recent years when central banks, a lot of them, been doing the same thing. So I think it's worth watching. So if we do get that sort of potential signs that the Bank of Canada could lower rates, then you'd easily see further move higher on dollar CAD, sort of to the 115 area. Any more questions, do let me know. Otherwise, we will wrap up and meet again, I think, on 2 weeks' time for this webinar. If not, the next webinar, let me have a look. I think I'm doing one on Thursday. But the next webinar on list, yes, is indeed on Thursday on the EA library, so you can join us then. And you can also join us on Wednesday the 29th, where we'll be looking at quant. Yes, and the next one along these lines is in 2 weeks' time, so when I tend to take a more fundamental look. So do join us for one of those, and as always, you can go to our YouTube page, just to search on YouTube FX Pro Marketing, and you'll see a webinars playlist. You can catch up some of the previous webinars on there. So I'll say thank you very much for your time and for joining us, and hope to catch